Imagine you're about to buy shares in a fast-growing company. The founder gives you two choices. Option 1. Buy ordinary shares today. Option 2. Buy something called CCPS. Both cost exactly the same. Both can make you rich if the company becomes successful. But only one gives you additional contractual protections if things don't go as planned. Which one would you choose? Most people buy ordinary shares because that's all they know. But professional venture capital investors usually choose CCPS. Why? What do they know that most people don't? Let's find out using a simple real estate story. Meet Raj. Raj owns a prime piece of land worth 1 Indian rupee crore. His dream is to build a luxury apartment complex. Everything is ready. The design is complete. Government approvals are in place. But there's one problem. Construction will cost another 50 Indian rupees lakh. Raj doesn't have enough money. So he starts looking for investors. His friend Amit is interested. Raj gives Amit two choices. Choice 1. You can buy ordinary shares in my company. If Amit buys ordinary shares today, he immediately becomes an owner. If the business grows, his shares become more valuable. If the business fails, his shares lose value. Simple. That's how ordinary equity works. Choice 2. Raj says, I have another option. You can buy CCPS. Amit looks confused. What is CCPS? Raj smiles. Don't worry. I'll explain. Raj says, imagine you're booking a premium apartment before construction is complete. You pay today, but instead of receiving ownership immediately, you receive a legally protected reservation. When construction reaches an agreed milestone, that reservation automatically becomes ownership. That's exactly how CCPS works. CCPS stands for Compulsorily Convertible Preference Shares. Let's break that down. Preference means the investor receives certain agreed rights that ordinary shareholders don't have. Convertible means these preference shares will automatically become ordinary equity later. Compulsorily means the conversion isn't optional. It happens automatically according to the agreed terms. So instead of becoming an ordinary shareholder immediately, the investor first receives CCPS. Later, those CCPS convert into ordinary shares. Construction begins. Month after month, the building gets taller. A shopping mall opens nearby. A metro station is announced. Property prices rise rapidly. 2 years later, the project is completed. The company is now worth 10 Indian rupees crore. According to the agreement, Amit's CCPS automatically convert into ordinary shares. Now Amit is a normal shareholder. His original investment was only 50 Indian rupees lakh. But now, his ownership is worth more than 3 Indian rupees crore. Same project, same founder, same investment amount. Only the type of security was different. Now imagine a completely different story. Construction stops. The economy slows down. Property prices crash. The project cannot be completed. Everything is sold for only 60 Indian rupees lakh. Now let's compare. If Amit had purchased ordinary shares, he simply shares the loss. If the business loses money, he loses money, just like Raj. But Amit purchased CCPS. His agreement includes something called a liquidation preference. That means, subject to the agreed terms, CCPS holders are paid before ordinary shareholders if the company is liquidated. The unfinished project sells for 60 Indian rupees lakh. Amit receives his agreed amount first according to the CCPS terms. Whatever remains goes to the ordinary shareholders. Now you can understand why professional investors negotiate CCPS. They still enjoy the upside when the company succeeds. But they also negotiate protections if things go wrong. You may wonder, if CCPS gives investors extra protections, why would founders agree? Because founders need capital. Without funding, ideas remain ideas. Products never launch. Companies never grow. CCPS creates balance. The founder receives the money needed to build the business. The investor receives negotiated protections. If the company succeeds, everyone wins. That's why CCPS is commonly used in startup funding rounds across India. Series A, Series B, Series C. Most venture capital investments begin with CCPS. Part 6. How investors make huge returns, 630 to 750. Let's continue Raj's story. 5 years later, Raj's company has become one of India's largest real estate developers. The company decides to launch an IPO. Before the IPO, every CCPS automatically converts into ordinary equity shares. Now Amit owns listed shares. After the applicable lockup period ends, he can sell those shares on the stock exchange. Remember, he invested only 50 Indian rupees lakh. Now his shares are worth 5 Indian rupees crore. That's a 10 times return. Not because he invested more money, not because he took more risk, but because he invested early in a successful company using the same type of security commonly used by venture capital firms. Many people think only venture capital firms can buy CCPS. That's not always true. Many startups also raise money from angel investors, high net worth individuals, family offices, investment syndicates, startup investment platforms. If you're investing in a private startup and have the opportunity, understanding CCPS can help you better evaluate your investment. However, CCPS is not a guarantee of success. Startup investing remains highly risky. Many startups fail. Always read the investment agreement carefully, understand your rights, and seek professional advice before making investment decisions. So let's go back to the original question. If someone offered you two choices, buy ordinary shares or buy CCPS, which would you choose? Ordinary shares make you an owner immediately. CCPS gives you a different path. You receive agreed contractual rights first. Then, under the agreed conditions, your CCPS automatically convert into ordinary equity. That's why experienced investors don't just ask, how much equity am I getting? They ask, what kind of security am I buying? Because in startup investing, the security you choose can be just as important as the company you choose. If you found this explanation helpful, don't forget to like, subscribe, and share this video with someone who wants to understand startup investing.